Welcome back. In lesson 2, I want to break down the difference between an IRA and a Roth IRA, explain the characteristics that divide both of them, and the similarities that make them a powerful retirement saving vehicle. So let's get right into it. An IRA is a 100% taxable account. A Roth IRA is a 100% tax-free account. So let me explain. An IRA, very similar to a 401k or an IRA or 457b, have all deferred any and all taxes to this point. All of your contributions into it, all of your employer's match, and all the growth has not been taxed. So when I say 100% taxable, all of the distribution or withdrawal from that account will eventually be taxed. A Roth IRA, on the other hand, is 100% tax-free or tax-exempt, meaning the dollars that you've put into this or contributed to the plan, yes, were once taxed, but all of the growth inside of that plan and all the distributions coming out are all tax-free. Now, how do you add to these type of accounts? The difference is an IRA has one way, which is a contribution, while the Roth IRA has two ways, a contribution or a conversion. An IRA and a Roth IRA both have contribution limits. Let's take a look at those. An IRA here in the year 2019 has a maximum contribution amount of $6,000 a year. If you're over the age of 50, you get an additional $1,000 of a catch-up contribution, which makes it $7,000 per year that you can contribute to your IRA. That full contribution amount is non-taxable or tax deferred. In a Roth IRA, the same limits are true for a contribution, the $6,000 or $7,000 if you're over 50. Now these contributions into your plan are not tax deferrable. You pay tax in that year that you contribute to the plan. The second way that you can add into a Roth IRA is called a conversion. In section 4 of this masterclass, we will further explain a Roth conversion, but suffices to say that a Roth conversion is when you take an existing balance of an IRA and convert or transfer it into an existing Roth IRA. The amount you convert is 100% taxable in that year, and there is no limit to how much you can convert. So the primary differences between an IRA and a Roth IRA is one, that's taxable nature, and two, how you can add to or build that account. Now that we've talked about the characteristic differences between an IRA and a Roth IRA, let me share with you a story about two sisters, one named Mary and the other one named Terri. The debate about which one of these type of accounts, a Roth IRA and an IRA, has been going on for decades. And I would like to share with you this short story about Mary and Terri and hopefully finish this debate right here and now. Now, Mary and Terri were sisters, and they had a lot in common. Both of them in their younger years, as they started their careers, wanted to contribute to their retirement. Both Mary and Terri had committed to contribute $5,500 a year into a retirement account. Both Mary and Terri were in a 27% tax bracket between federal and state. Both of their retirement accounts experienced a 6% interest over a 30-year invested period. Now that's where the similarities between Mary and Terri ended. Both of them decided to choose a different type of retirement vehicle. Mary chose a traditional IRA, and Terri chose a Roth IRA. For Mary, her contributions per year were $5,500 of tax-deferred income, and after the 30-year period of all of her funds growing at 6%, she ended with a balance at retirement 30 years later of $434,820. For Mary, still in a 27% tax bracket, the after-tax dollars or after-tax value of that account was $317,419. Terri, choosing to invest in a Roth IRA, continued to contribute that $5,500 a year, but she paid tax in the year that she contributed, so the contribution amount into her Roth IRA each year was $4,015. Now, 30 years later and 6% interest later per year, Terri ended up with an after-tax balance of $317,419. For both Terri and Mary, all things kept equal, the traditional IRA and the Roth IRA netted the same after-tax dollars. Now, a few questions to consider are, which account is better, traditional or a Roth IRA? As we can see from Mary and Terry's example, if all things stay consistent, neither account is better. However, life doesn't always give us consistency. So the next question is, what if tax rates increase? Who comes out ahead, Mary or Terry? Well, clearly Terry does, because she had paid the lower tax brackets all along throughout her working years. The last question is, what if you're not in a lower tax bracket in retirement? I ask this question because conventional financial wisdom often tells us that you'll be in a lower tax bracket into retirement. I'm here to tell you that is not always the case. If we go back to the opening example of Bill and Janet that we shared at the beginning of section 1, do you recall or remember that they were actually in a higher tax bracket well into retirement once the required minimum distribution started? Yeah, we're going to talk about that in the next section, but I wanted to bring that up so you consider which one of these accounts is better. It depends. As we unfold your tax story and really dig into your numbers, this will clearly come out for you. We'll see you in the next lesson.